And joining me now for a closer look at the day's market moves is Mutooni from Sanlam Investments. Roy, thanks so much for your time this afternoon. So we have the last key data point before the Fed's next monetary policy meeting due today, that of course being CPI. What are your expectations on that front? I mean, we haven't even really seen the full impact of those tariffs coming through to prices.
Well, the feeling is that in all likelihood, some of it has been absorbed within the supply chain.
Yes.
So it hasn't quite come through, but it's been felt in margins and in cost of goods, and that's why we haven't seen it in inflation. But I think the reality here is that it is unlikely that you have a substantial surprise to inflation now. I think expectations are for something like 3.5% annualized core inflation. That would be in line with expectations, and I think that's pretty much where we are.
And with that being said, are you in the camp that says that we are probably going to get a cut from the Fed next week?
If you think about it, inflation expectations are still relatively well anchored at that 3% level. The job market, despite all the revisions and everything, is pretty solid. So it's one of those job markets where there's no aggressive hiring or firing. It's employers are holding on to jobs. But you look at that trend line, and the uncertainty around tariffs and everything means that in all likelihood, the Fed should cut. And I think that's what's being priced in. The surprise would be, well, it's becoming more and more the default, is if they go higher than 25 basis points, or if they guide to continuing cutting through the rest of the year. I think this in the phrase, it's probably pricing another 2 or 3 cuts. That's what we're going to hear from what the Fed chairman says in his statement. But I think the consensus now is more and more likely that you will see a cut. The only question is how many and how big up front.
All right, let's move over to some company news, bringing it back home and starting with Old Mutual. Adjusted headline earnings up 29%, and the group pointing to stronger equity markets, personal finance, wealth management performing well, as well as insurance performing well. Earnings aside, it launched a 3 billion rand share buyback. What have you made of those numbers and that decision to launch a buyback?
So the buyback is quite a significant thing because 3 billion is big in their lives in the context of their market cap. The results were much of a muchness, pretty much in line what you would expect from an insurer that's in the markets like insurers tend to be. There was really nothing surprising there, but I think the market likes the buyback. The market likes that this is the first result that the new CEO is presenting and is looking forward to see what strategy that he does come through. So I think positive for the markets, positive from the perspective of the buyback, nothing really bad operationally. Their new business numbers were a little weak, but that's to be expected in the current market situation.
I don't know, I would have expected that share price to be high. I think it's just up over 1%. Are we perhaps seeing the downbeat sentiment playing out in the rest of the markets, maybe weighing on that share price?
I think there's two things that could possibly be weighing on it. First of all, remember, there's still the bank to come, and they're still investing in the bank, and that's going to take a lot of capital. And secondly, the big rally in commodity stocks has to be funded from somewhere. And what we're seeing is a lot of investors selling out of their SA Inc. Investments and putting that into the platinum, gold, and diversified miners. So I think it's a combination of those two factors.
All right, let's move over to the property sector, where Growth Point delivered higher distributable income and also hiking its dividend. The firm says this was in part driven by a good showing from its local portfolio. And interesting to see the dynamics that are playing out in the office portfolio in particular, where they are seeing some strength in KZN and Cape Town, but offices in Gauteng not doing too good. Is this as a result of that immigration trend?
That would be interesting to dig deeper into. But I think the thing is, office has really struggled over the past few years.
Yeah.
And this is the first time when you're hearing, not just from Growth Point, but from the others, that the vacancy trend has basically bottomed out. Gauteng was always the big focus of office, and that's why you'd have more excess capacity and, remember, a bigger spread in quality. So from P all the way to C grade. So you would expect Gauteng to have the bulk of those vacancies. Western Cape, a lot of those offices are probably newer, higher quality, higher standard, higher grade, and that's probably why you don't have much in terms of vacancies there. So I think it's more a structural thing that developed over time. But I think the message here is that the weakest part of the property market seems to have found a floor, whereas the stronger sides, which is the logistics and the retail, are actually seeing positive reversions, which means that they're able to increase rentals when leases come to an end, which isn't something they've all been able to do over the past few years. So positive for Growth Point and positive for the sector as a whole.
All right. So a sector that has really been performing well, as you touched on, is the commodity scene. The gold counters really coming through with double-digit earnings growth. No different in Pan-African Resources results. Earnings, they up over 40%, of course, boosted by the higher gold price as well as a higher gold output. What have you made of those numbers? And do you think that we would have gotten even higher earnings if it wasn't for that the hedging structures?
Without a doubt, if they had it hedged, we would have got higher earnings. But remember, it cuts both ways. If the gold price hadn't really rallied, the hedge is the one that gives them a bit of a floor.
Yeah.
But I think when you look at this business, they've managed their costs really well. They're all in sustaining costs, and they're guiding for increased production and sustained cost growth. So as the gold price holds up where it is, they're going to be delivering into a higher gold price. Their costs are going to remain low. So it just seems that the earnings growth momentum continues, and I think they also declared a buyback. So these are the good times for these well-managed businesses. The gold price is rising, they're keeping their costs under control, so they're generating a whole lot of cash, and that's really positive for shareholders.
All right, let's hit pause on the conversation before we get to your stock pick. Let's take a moment to touch on what counters your industry peers are watching closely.
In a bubbly market, potentially, I want cash. And not necessarily US dollars, but I know that Mr. Rupert likes to keep his cash in Swiss francs. I'd be quite comfortable with that. That cash has not come into Reinet yet. They are selling their pension corp stake, and they said they expect that to close early in 2026. So I don't expect any big changes, any announcements in Reinet's strategy until then. So you can hold your breath till 2026, and then you can start exhaling. And the question is anything going to change? Well, maybe nothing changes, but then at least you're buying a bunch of Swiss dollar cash at a discount. That's effectively what you're buying if you are paying the current share price for Reinet. It is going ex-div tomorrow, so don't be scared if you see a little share price drop tomorrow. But, you know, the other scenario is that Mr. Rupert calls it a day. And he says, no, he's had enough with this investment holding company. He wants to play more golf and spend time on his wine farm. And if that is the case, then maybe it unwinds. We all get a special dividend, or maybe it does something else. So I think your downside is relatively limited. You have a lot of cash, so it's very safe.
Into Sprot's vehicle, U.UN on the TSX, or U.U on the TSX, if you want it quoted in dollars, basically. Chemicals themselves are short 8 to 9 million pounds just in the next few months. They have to go buy that in the spot market or find someone else to contract that. There's maybe a few million other pounds short that utilities must contract in the next few months. The window to contract this stuff is closing. Uranium at 70 odd bucks is not expensive by any means. It's a pretty small input into the larger, costs of operating a nuclear plant, and that's in a very supply constrained market, the demand side is very, very inelastic, and if it starts running, I don't know where it will stop.
All right, so Drick is picking one I'm not really familiar with, Sprott Physical Uranium Trust. And then JP going with the good old Raynet. Your thoughts on those counters?
Yeah, so you had the really clever boys on the show that time. So those, it's very insightful. What I agree very much with what JP was saying. I think right now it's an asymmetric risk profile for Raynet. It's either cash and the discount closes and you have cash in your pocket, or Rupert comes up with something that is worth being invested in together with him into the future. So as the market is volatile as it is, this provides your sort of defensive component of your portfolio. So yes, I agree with him. It's well worth holding. Uranium is very interesting. Remember that uranium is a core component for nuclear power stations. Yes. Growing demand for energy in the world on the back of AI and data centers is a big, big thing. And you've seen people starting to build these nuclear power plants yet again. And on that basis, the demand for uranium must be growing over time. And that is a structural thing that will keep, the demand will keep rising, and which means there's a big underpin to the price. So yes, I think I would agree with both of them.
All right, then let's get into your stock pick. Where are you seeing opportunity at the moment, Roy?
So I like MTN. I know the stock sold off when all of these DOJ discussions came on a few weeks ago. But in my mind, when I look at where the price was and where the price is today, it's highly unlikely. I mean, nothing's impossible, but it's highly unlikely they get a fine that big. And in reality, when you look at it from an operating perspective, you're going to see double-digit earnings growth over the next 2 to 3 years from this stock. It's well diversified among very strong growing African countries between Nigeria, Ghana, Uganda, Cote d'Ivoire, Cameroon, and a bunch of all others. And even if in SA they're losing ground to Telkom, SA is now the third largest in their portfolio. So you put it all together, you probably get a compound 20% earnings growth. For where it's trading at right now, I think there's significant opportunity here that the market is missing because they're overpricing the risk of this DOJ investigation.
And just quickly before I let you go, throwing a span in the works around MTN. You know, while the CEO has poured cold water on those rumors about the group having talks with Telkom to buy some of its assets, do you expect MTN to be on an acquisitive path, particularly when it comes to those fiber assets, just looking at where, you know, one of its competitors, Vodacom, is at with that Vodacom massive deal?
I really don't think so. I think you can get access to fiber without necessarily owning it. And one of the things that the Competition Commission assured and the Competition Tribunal was that you still have open access to Dark Fiber Africa and even OpenServe as well. And there's also a whole bunch of other players out there. So yes, when you're big MNO, ideally you want to own everything, but maybe for the stage where they are, it's an inefficient use of capital at this point in time, and maybe what you'd rather do is piggyback on another infrastructure provider. Remember, the whole point here is you don't want one more person putting more fiber and messing up with all of our pavements and gardens, putting fiber that becomes excessive supply. So no, I don't think they're disadvantaged. I don't think it's a big priority for them. I think there's already a very clear growth profile that they have outside of South Africa. In South Africa, they need to deal with their prepaid business more than anything else.
Oh, well, let's leave it there. Roy, thanks so much for your time and just taking us through trade at midday. That was Roy Mutooni from Sanlam Investments.